Okay, we're live. Okay, welcome everybody to Wall Street Reporter's next super stock company spotlight. Today, I am back with Johnson, CEO of Peak Fintech. Once again, our next super stock presenter stock symbol is PKKFF, PKK on the CSE. Johnson, welcome back.
Thanks, Jack.
So, Johnson, every time you come back, it's always good because the stock is usually up. So the stock right now is looking really good. I think we hit $1 today. It was just about 40 cents, when you first came on, when you first debuted about 6 weeks ago. So there's a lot of interest in the stock. Every time, you've been coming on, there's more and more. The audiences are growing. So listen, congratulations, on the double in the stock, but Johnson, our audience, they're looking for, 10x to 100x upside. So what we need to do, the whole point of today is for you to tell us what's happening, like what's gotten the stock to where it is, but more importantly, what's going to happen to get the stock to that 10x level.
Okay, let me start by answering the first half of that question. What has been happening, seriously, Jack, has been the awareness. Peak has been one of the best kept secrets in the stock market, the microcap, for a number of maybe months, even a year now, and we're looking to change that. So we come on programs like yours, and we're trying to get the word out, and getting the word out to new investors. And when those new investors take a look at the company, what they see is they see a company operating in a very attractive space. The Chinese fintech space is probably the largest in the world. You have some very, very large companies operating in that space. We have access to over 100 million businesses to which you can sell their services to. Company's been growing at a very, very rapid rate. So they see a company that went from 1.6 million in revenue in 2018 to 11.7 million in revenue in 2019 and forecasting 40 million in revenue this year. So they see exceptional growth. So that's attractive to them. And we've also announced a number of significant deals over the past few weeks and months. Notably, we announced a deal with the city of Nanjing, where we're going to be the engine behind a commercial lending financial center that the city is going to be launching with us over the next few weeks. And we also had a significant deal with a national consumer electronics distributor called Beijing Diagen Company. So we call the company BDC for short. But that deal alone gives us roughly about $1.3 billion in annual revenue if we are able to sell our financial services to their 60,000 plus online retailers. So the last thing is that, frankly, investors can count, right? So they look at a company back in August that was barely trading at 1 times forecasted revenue. When you compare that to other fintech companies that are trading at 10 to 15 times forecasted revenue, investors can tell for themselves that this is a bargain. So even at these recent prices that the stock is trading at, if we were to trade at the same multiples that some of the other fintech companies are trading, our market cap should be about 4 to 5 times higher than it is right now. So that explains why people have gotten behind the stock, behind the company.
Yeah, I mean, at least, I mean, some of the peers your peers in that space are trading at 10x higher than your multiple.
Yeah, on average, we're saying 10 to 15, but some of them are trading at 20 to 30 times multiples.
Yeah, the market's crazy. So we're going to actually we got a bunch of questions that are just coming in from the audience. So we're going to get into all those questions in a few minutes, because that's really what this is all about, is getting your answers to their questions. I think, look, so the good news is the revenues are exploding. I mean, the market obviously is it's a massive market opportunity, and that kind of brings us kind of to the I think the elephant in the room, or ironically, is the ant. The ant is the elephant in the room. And look, that IPO, I guess it's on hold. Whatever's happening there, it's they got their issues going on there. There's some political stuff. So I think that at the same time is just highlighting how big the opportunity for the fintech space is, what you're doing. And then I guess the question is, And I think some of the money people are, they say, hey, we can't buy Ant. Can we buy, Peak? But then I think one of the big questions, and I see a lot of people are asking this, is how are you different than Peak? What's the difference between Peak, excuse me, than Ant? What's the difference between Ant and Peak right now?
Yeah, let me start, Jack, by addressing. I know that a lot of people are concerned about the regulators that have put the Ant IPO on hold right now. And let me start by saying, first of all, that what the regulators in China are doing is very important, and it's actually beneficial to companies like Peak and to companies like Ant. Here's what I mean. A couple of years ago, when we pivoted to the fintech space in China, there were a lot of P2P lenders. And honestly, the P2P market in China was the wild, wild west. I mean, it was, some of the companies were operating illegally. Consumers and businesses alike were being taken advantage of. Some of them were running pyramid schemes, you name it. So the government stepped in with some regulations a couple of years ago and really wiped the slate clean and got rid of all those companies. It was bad enough that not only did some of those companies shut down, some of the executives actually went to jail. So the whole P2P industry in China was giving platforms like ours, like Ant's, a bad name. So we're really, really glad that the regulators stepped in and cleaned all of that stuff up. Now Ant is not a P2P platform. Neither is Peak, by the way. But Ant is running into some regulations, and here's why. Ant is not just, by the way, it's Ant Group. It's not Ant Financial, right? They changed their name from Ant Financial to Ant Group. That's because Ant offers a variety of services. So they offer banking, they offer investment services, insurance. Everybody knows, I think, Alipay, which belongs to the Alibaba Group, but also actually belongs to Ant Financial. So they have payment processing. They have a whole bunch of services that they provide, so that the government considers Ant not to be a fintech platform, but a diversified financial services company, right? So if they're going to be portrayed in that way, the government says that Ant needs to abide by the regulations that the banks, the insurance companies, and all of those other companies abide by. So that's the issue right now for Ant. And that's why their IPO has hit a bit of a snag, so to speak, right? But we are totally different because we are not a financial, diversified financial services company. We're truly a platform. And that's the main difference between us and Ant. Now, there are some similarities, obviously, between us and Ant. And those similarities are the fact that, yes, we are a platform. We operate in the fintech space. We have some of the same clients. Ant focuses more on the consumer side of things, whereas Peak focuses more on the small business side of things, right? And excuse me. Ant also has built a company based on a model, on a subscription, not subscription, but membership model, right? So it's kind of like Amazon. It's a blueprint that these companies have taken, right? Amazon, Alibaba Group. So they bring you in, right? So they bring you in, you become a member, and you use their services. All of a sudden, they gather information on you. They continue to grow that network. They offer you more and more services. So Peak is the same way. Right now, we have an ecosystem of small businesses that are, we're hovering around 25, 30,000 small businesses that are part of our ecosystem. And just like Ant, we're growing that ecosystem slowly but surely. Now, the deal that we just signed with the BDC, that's a deal that can allow us to grow very quickly. So all of a sudden, we're adding about 60,000 small businesses to our ecosystem. So with that one deal, we're doubling the quote unquote membership of the Peak ecosystem. But similarly to Ant, what we're doing ultimately is we're growing this ecosystem where we have data on all of our members and we're able to offer them services, financial services, but other services down the line. Now, the difference between us and Ant and why we shouldn't be concerned about the regulations is that unlike Ant, they offer those services themselves directly. They offer loans, they offer insurance, they offer all these things. We do not do that. The main difference between us and them is that we are, quote unquote, really like a broker. We're in between, right? So we leverage our platform and we offer these services to banks right now, but we may, in all likelihood, we will offer insurance. We'll offer different products to our members, but we're not going to do that ourselves. We're going to offer products, and we're going to charge a fee for the matching.
So I think the main thing is essentially, you know, Peak is purely a tech platform. You're not touching the cash, which Absolutely. I think the government, the Chinese government, it makes them probably more comfortable because I think they probably don't want to have anybody have too much control, you know, in certain areas, you know?
That's the other thing. Ant has grown so large right now that they're actually competing. They're competing with banks, and it is a worry for the Chinese government. If you have an account, whether it's Alipay or any other account within the Ant group of families, you can hold savings. They offer you investments, right? They have, I think, I forget the name of the fund, but Ant actually has a money market fund, if I'm not mistaken, that last year in 2019 was the largest money market fund in the world. So you can see why the government sees them more as a diversified financial services company as opposed to a pure platform.
So yeah, so basically, okay, so just I guess the bottom line for investors, okay, so Peak essentially is purely a tech platform. You're not really touching. You're not touching. I know you did a little bit when you started off. You were doing some loans directly, but essentially now it's purely a technology business.
We are, yes, that hasn't changed, by the way, Jack. The platform remains the platform. We have a subsidiary, right? We have a subsidiary that is itself a lender. That subsidiary has to abide by the regulations, but that's outside of the Peak platform, the Peak, what we do, right? So that's not an issue. It's a small part of our business. It is regulated. It's going to continue to follow the regulations, so it's not going to be an issue for us.
Okay, so yeah, we're going to jump into the question. I think one of the key things is the BDC deal. You said potentially it's about $1 billion in, you know, total. I mean, that's their total ecosystem of, you know, 60,000 could result in $1 billion, but you know, obviously you're not going to get the full $1 billion, you know, in the first year, right?
Not right away.
Okay, I like that. Think big. All right, so let's jump into some questions, and then we'll kind of circle back. So, Safraz was asking about: is there an analyst report coming out on Peak?
Yes, I don't know how Sarfraz got that information, but he's got some good contacts. Yes, there should be an analyst report published on the company within, I would say, within the next couple of weeks or so.
Okay, and you had a report actually back in what is it? The what's I'm trying.
Yes, we had a report that was done by E-Research.
E-Research, yeah, great report. Yeah, great report.
Yes, it was a Canadian research company, but now we're getting a research report done by I believe it's Zacks. More geared towards the U.S. market. So better distribution to the U.S. audience.
Okay, so Zacks, you know, look, Zacks does really good work. You know, they're very well respected. But the E-Research also, I mean, that report was great. I mean, I think if I recall, it was a $2 target that they had on the stock.
That's correct. Yes. Yeah, the Zacks report should be a little bit more up to date because it will take into consideration some of the later agreements that we've had, whereas the E-Research report does not factor that in.
Yeah, that was kind of an old. So yeah, so that'll be good.
That report will probably be refreshed as well, but we're looking forward to get the Zacks report out in the next couple of weeks.
Okay, so Safraz is jumping right into the the good questions. When are you putting out revised projections?
Yes, we did mention that in light of the new agreement with BDC that we will be looking to revise the forecast that we put out earlier this year. We were forecasting 40 million for 2020, and I believe it was 55 million for 2021. But because of the revenue potential coming from the BDC deal, we will revise those forecasts. Now, we may do that before the end of this year. We're still crunching some of the numbers, looking at talking to our partners and seeing what's feasible. Yes, you mentioned earlier that it's a potential of 1.3 billion in annual revenue, but realistically, what can be expected over the next 12 months, 24 months, that's stuff that we're still trying to determine right now before we publish a revised forecast. But we will do that eventually.
Okay. I mean, even if it's an extra 50 million, that would still get you to 100 million run rate, and that's worth at least 500 billion in market cap.
I'm not going to comment on that, but we're optimistic.
Okay. So okay, so, and then we'll talk about future deals because we're just scratching the surface. Yeah, we definitely have to get into that because I think investors need to know that the story hasn't ended with just this BDC deal. I mean, you have more stuff in the pipeline, right?
Absolutely, absolutely. I mean, the BDC deal is a blueprint for us. Obviously, they're not the only distributor in the country, so yeah, we can talk about that a little bit later on.
Okay, yeah, and I want to ask you more about the other e-commerce financing opportunities you have in China. I think. Okay, so Adrian is asking, what's the this is, I guess, touching on what's the expected penetration for small to medium businesses in the Jiangyin deal, and how much does it mean in terms of revenues? What can you do in revenues from the Jiangyin deal? That came out last week, right? About a week ago.
No, that was what came out last week was the Nanjing deal. But I think what Adrian is referring to is to a financial center. That was actually the first financial center that we created was in the city of Jiangyin. Jiangyin is a little bit smaller than Nanjing in terms of the number of businesses that are in the city. There's about 200,000 small and micro businesses in Jiangyin, whereas there's about like 600,000 plus in Nanjing. But specifically, what we expect from the Jiangyin deal, let me just say that that financial center is in operations. So there are revenues being generated as we speak from the Jiangyin deal. Now, it's too early to tell, unfortunately, Adrian, what can be expected. If you recall, our first foray in Jiangyin was to provide supply chain related financings. So that's how we started. A lot of the business is still supply chain related, but more and more now we're getting more traditional or non-supply chain businesses that are subscribing to loans via the financial center. But it's too early for us right now to tell just how much the penetration rate will be. We should have better visibility into that in the coming months. Probably like first quarter of 2021, we should have enough data to be able to answer that question.
Okay, yeah, I'm getting my cities mixed up. I just know Tinghao, right? That's that's where I'm a little bit. Okay, so we covered this, right? The projections, earnings release coming up.
What was the question?
Hang on a second. So we just he's asking about when is we get a lot of. Sorry, we just got a ton of I gotta scroll up here. We get about 100 questions that just came in here. Hang on. Okay, here we go. Amin is asking about the revised projections, which you covered. Earnings release. When is the next earnings release?
That's going to be November 27th. So we're about 3 weeks away from that.
Okay, so that's coming right up. Jeremy is asking. I guess he's asking about how many of your shareholders are coming from China. And do you expect awareness in China of Peak to have an impact? I don't think you have any Chinese, do you? I mean, from China.
We do have investors, Chinese investors that have invested in the stock. We wanted to make sure that they also wanted to make sure that their interests are aligned. So some of our biggest shareholders are actually Chinese.
Okay.
Yeah. So, but as far as giving broader access to China, we would have to do that because it's difficult for Chinese residents right now, even residents in Hong Kong, to buy the stock because once it's listed. If it's not listed on a major exchange, so we can talk about that a little bit later on. But that's one of the reasons why we want to uplist to the Nasdaq, to give broader access, I should say, to overseas investors.
Okay. Yeah. I mean, I guess in terms of like shareholders from China, you have from the mainland. Do you have shareholders right now, or here in the U.S. Or Canada?
No, from the mainland.
Okay.
Yeah.
It is like you said. It's difficult for them to really buy, to send money out of the country. Really, no.
Correct. Yes.
So, okay. So I guess container guys. Johnson, I guess he's asking, how confident are you in that 40 million run rate becoming reality, like concrete?
Okay. Yeah, we keep getting that question. I think the third quarter numbers will give people a better idea as to whether or not we will hit those. We will hit that target of 40 million. But I'm going to sit here to let everybody know that I'm not concerned at all about making the 40 million dollar target for this year.
Okay. You mean for 2020? You're going to do, or 12 months? You're talking about the
No,
run?
for 2020. I mean, if you're not aware, Jack, we had forecasted 40 million in revenue for this year in 2020,
Okay.
and I know that some people are concerned as to whether or not we're going to hit that target. So that was the question. So my answer is that the third quarter results will give an indication to people as to whether or not they believe that we're going to be able to hit our target of 40 million this year.
Okay. And what about, now he's asking a follow-up, what about 100 million? Can you do 100?
I'm not going to comment on doing 100, at least not this year.
Okay. What, John, do you see the question? Can you read that? I can't read that.
Any updates on Ginshar platform and outsourcing expenses?
Ginshar.
Yeah, Ginshar is, for those who don't know, that's the loan brokerage platform that we acquired at the end of 2019 and integrated to the lending hub, to the Cuba lending hub earlier this year. Yes, there have been some developments with the Ginshar platform. More and more sales reps are using the platform, and we are using Ginshar as expected to expand their services to different cities. Ginshar was actually very instrumental in helping us get the connections to the Nanjing Financial Center deal. So Ginshar is paying dividends. As far as the expenses are concerned, I know that people are concerned about some of the margins that we showed in the second quarter because of outsourcing services. Now, what we told people is that 2020 is going to be an investment year for us. The company's grown, right? So as you grow, you need to invest. So there are going to be a lot of one-time expenses in 2020, let's just say, that will not reoccur in 2021 and beyond. So profitability is expected to increase beyond 2020.
Okay. Amir is asking, when are you going to have a third city announced?
Okay, so if he's talking about, I think he means a financial center, because we're already in multiple cities already in China.
The deal that you announced, like the financial center stuff you were talking about.
Right. So far we are in Jiangyin. We just signed a deal with Nanjing, although that the Nanjing Financial Center has not been launched yet. We expect to launch that later on this year. Third city, listen, we're always in discussions with other cities. Obviously, like, I mean, once a city sees something, it's working, they like the concept. So that's what happened. That's why we're able to sign Nanjing. I can't say right now that a third city is imminent, but we are having discussions with a couple more cities to be able to replicate the financial center.
And how does that work? Basically, what, like you it's kind of like a public-private partnership with the local government, where the city kind of, leads.
If you will, like, I mean, the governments are always trying to foster economic growth, right? They want to make sure that cash gets into the hands of the small and micro businesses because they contribute so much to local economies, right? So they know that the small and micro businesses have a tough time getting credit, right? So they see this platform that automates the process of distributing credit to small and micro businesses. So the government says that, hey, with this financial center concept, we're going to invite the banks that operate in the city to become part of the quote unquote financial center. And they're going to use this platform in order to find and qualify small and micro businesses for credit. And what the city of Jiangyin did was that they said, okay, they told the lenders of financial institutions, they said, listen, if you become part of this financial center, you use this platform to qualify our small and micro businesses for loans. Because we trust this platform, we will be willing to guarantee some of the loans that you make through this platform. So that's the advantage really for small businesses, for financial institutions, by using or being part of this financial center concept. So we're working in concert with the governments, and we're providing the engine to find and qualify the businesses for loan.
Okay. Johnson, we got a ton of questions coming in, and we're kind of running out of time. I'm going to try to get a couple more questions, and we'll have to have you back. You know, when you first started off, there was hardly anybody in the audience, and now we have a couple hundred people here. So actually, here's an interesting question. I gotta pull this up. I guess he's asking, would you sell is PKK at what price would PKK be for sale? $2, $5, $10 a share? How much? Would if Ant offered?
You know what? Honestly, I haven't thought about that. Our focus right now is to grow the business, right? So we want to grow our ecosystem. We believe that, as you mentioned earlier, Jack, that we're barely scratching the surface of potentially what we can do in China and potentially in other parts of the world as well, right? So our focus right now is to continue to grow the ecosystem, grow the business, revenue, profits, and of course, if somebody approaches us and there are synergies and they think that they can work well with us or whatever, we'll listen. But right now, there are absolutely no plans we haven't been approached, first of all, but it's not something that we think about. Our focus is really on continuing to build and grow the business.
Okay, let's do 2 audience questions, and then we'll kind of wrap up with, I want to ask you about what else you have in the pipeline coming up. So Safraz is asking about NASDAQ.
Okay, you're trying to list on 12 months. Can you meet the mirror?
I guess without doing a reverse. In other words, can you get your stock to, let's say $5 a share?
Yeah, that's an excellent question that we get all the time. And you know what? That's why we're here. We believe that we can do it, Sarfraz. We believe that we can get there without doing another reverse split. There's a lot more room for growth and the market cap of the company. So we're going to continue to work towards that. So certainly within the next 6 to 12 months, our expectation is that we will meet the minimum share price requirement for us to apply on the NASDAQ.
I mean, look, I think if you actually start generating, 15 million revenues per quarter, the stock price will be, $4 or $5, maybe or more. I mean, it's once the market kind of sees the revenues accelerating and they kind of see that kind of the tempo and all that, that's usually what happens.
As I mentioned before, Jack.
This is opinion. This is not, guaranteed.
No, but as I mentioned before, if you compare Peak to other companies in the space, fintech companies, and you basically just apply the multiple that some of those companies are getting, the 10 to 15 times, and I'm not even talking about the 20. Some of them are getting 20, 30 times, right? So I'm not even talking about that. I'm talking if we just apply the 10 to 15 time multiples to Peak that some of the other fintech companies are getting right now, we should qualify to list on the NASDAQ. So is that going to happen between now and the end of the year and the first quarter of 2021? We don't know, but eventually we believe that will happen, and that's what will allow us to uplist to the NASDAQ.
Okay. So let's do last audience question, and then we'll Johnson, we got to get you back here in about a week. So probably after your next news release, because we're getting there's got to be 100+ questions more to go here. Rahil is asking, do you have any potential acquisitions in the pipeline?
Oh, that's a bit of a tricky issue. Listen, we're always looking, right? We're obviously operating in China. We're dealing with the government at the city level sometimes. So we have companies approaching us, believing that they can add value to the group. There's some interesting technologies that we see out there, and our eyes are open. Now, are we in discussions right now, as we speak, concretely for an acquisition? No, but let's just say that there are opportunities around right now that we would be looking at. So yes, if there is a fit for a company that would bring value to our group, synergies to our group, yes, we'd be willing to make an acquisition.
Okay, I said last question, but I'll do one because Graham is one of our big contributors here. Would you explore going into India? I know I think we've talked about it in the past. No, like other markets.
Yes, we did. I think and on one of the earlier appearances, I did mention India. India would be an attractive market for us. Obviously, huge potential, similar to China. A lot of businesses out there, particularly small and micro businesses, which is that's our niche. And we do have a couple of contacts if we wanted to venture into the Indian market. Now, it's not something that we're looking at over the next 6 months, but potentially over the next 12 to 18 months, I would say, yeah, that's possible. Yeah.
I think the key takeaway is that you can kind of export your model worldwide, because look, if it works in China, which is a tough market, right? I mean, that's like one of the most challenging markets. You could do this in other markets. It should be very compelling.
Absolutely. Yeah, this is the concept that can be ported virtually in any part of the world.
Okay, so let's kind of wrap up here. We got what else do you have in the pipeline? Like, what's kind of the new? Like, you got this deal with BDC that got a lot of investor interest. Obviously, it's a major, it's a sort of a major revenue opportunity. Mm-hmm. What other kind of deals do you have in the pipeline? Like, what kind of news flow can investors expect? As we kind of head into the end of the year here.
Okay, first off. The BDC deal itself, the agreement is signed. We tweeted a picture, I think, yesterday about the development teams of the BDC and our developers in Wuxi getting together. There's some integration work being done right now. We're hopeful that the integration work will be done, I would say, over the next few weeks. So certainly before the end of this year, we expect transactions to start to happen with that BDC agreement. So number one thing is that investors should be looking for is an announcement of us saying that, hey, the project is on the way. We've had the first transactions related to the BDC. Secondly is the launch of the financial center in Nanjing. Again, we won that bid. That was the first step. Now there's an agreement being negotiated right now with the city of Nanjing. That agreement should be signed within the next couple of weeks, I would say. And then the financial center should be launched shortly thereafter. So that's the second thing. The third thing is, as you mentioned, as we were talking about earlier before, the BDC deal, the BDC is just a product distributor. Obviously, they're not the only product distributor in China. And consumer electronics are not the only things that are sold online or in the real world in China. So what the BDC deal did for us was that it provided us with a blueprint that we can replicate and make similar agreements with distributors, whether it's food distributors, appliance distributors, you name it, right? So we're actually in talks right now with a couple of distributors, and what investors could be looking for is more than likely before the end of the year, there will be another announcement similar to the BDC deal announced between now and the end of the year. Finally, the last thing that investors should be looking for is, it depends on the stock price, but we're very close, as we mentioned, to meeting all of the requirements to list our securities on the NASDAQ exchange. So that's something that we're looking to be able to do potentially before the end of the year. If it's not before the end of the year, then certainly we believe that early 2021 we should be ready to submit our application to list on the NASDAQ. So okay. There might be other things like surprises, but those are the major things that I think that investors should be looking for between now and the end of the year.
Okay, yeah, there's definitely. I mean, the China fintech space is hot now that the ant is off the table. There's like this pent up appetite. There's this demand for these fintech deals. So if you're on NASDAQ, that'll definitely have some buyers. I want to ask you, Johnson. We're going to kind of wrap up with two last questions, and we'll get to our next presenter here. So Johnson, here's in terms of from your perspective, like what's kind of your vision for the company? 2 years out, what is peak fintech going to look like? Assuming everything goes right, like Is this going to be a $1 billion revenue? Like, what is the company going to be doing? And are you going to be in China, globally? Give us your kind of vision.
Okay, I'm not going to talk because we haven't put out our forecasts yet. So I'm not going to talk about the revenue, what we're expecting yet. But in terms of vision, what we expect is, as I mentioned before, we just want to continue to grow our ecosystem. This is an ecosystem that we have built. There are small businesses that are being added to that ecosystem on a daily basis. There are financial institutions, brokers. We've been approached by insurance companies. So as we continue to grow that ecosystem, we're going to have an opportunity to offer more services. And when I say offer more services, I'm not talking about us, like Peak itself, kind of like the way Ant is doing it. They're offering services themselves and they're subject to regulations, right? We don't want to do that. What we want to do is we want to be true to our model where we are a technology platform, right? We facilitate a way for those companies, the banks, the financial institutions, insurance companies, to tap into our ecosystem and provide services to our members, and we charge them a fee for doing so. So that's the concept. That's the vision that we have for Peak. So we see this growing. We're in the thousands of members right now. Okay, so if we can get to hundreds of thousands, obviously, like, I mean, we're generating 40, 50 million, 100 million with thousands of members, right? So if we can get to hundreds of thousands of members, potentially millions of members, then you have, you know, then it gives you an idea of just how big Peak Fintech Group can be. So now, as far as expanding to other markets, yes, as I mentioned earlier, certainly within the next couple of years, we see ourselves being outside of China, India, potentially other parts of Asia, and potentially in, you know, Europe, North America as well. You never know. But our vision is really to take our model, our ecosystem, and grow it basically globally outside of China.
Okay, you know, one thing we actually haven't talked about recently, which I think is a big, kind of a big deal, is that, you know, you essentially, you know, we didn't really talk about the technology so much, and part of the thing that, you know, drives the platform is kind of the, you know, the AI behind it, the big data, the algorithm, and as right. Your ecosystem grows, the machine learning, you're getting all this data coming in, so you kind of see,
absolutely,
you know, what kind of loans work, what don't, you know, the customer behavior. So that becomes extremely valuable.
Absolutely.
Literally, this is like
yes.
a big data deal. This is
that's an excellent point that most people miss. But yes, the analytics part of our company over the next couple of years might exceed what we're doing right now in terms of charging a fee, right? We're charging a fee for facilitating transactions, but there's a whole business model with the analytics, with the data that we have not tapped into yet, that we will begin to tap into over the next year, couple of years, certainly. So that to me, that's probably the most interesting part of our business.
The analytics, I mean, that AI, that component could be more valuable. I mean, like people, you know, it's like we have
not it could be more valuable.
The existing thing right now.
It will be. It will.
And the revenue.
It will be. Yes.
It's and we should talk about that more on the next live stream. Talk more about the, you know, the AI aspects, you know, the data aspects, you know, the valuation of that, because, you know, again, like what we're seeing with companies that are in that, you know, they have the big data angle, like what, you know, it's just what an incredible business, which just becomes more valuable like by the minute as data comes in. So
as I mentioned, Jack, we're just scratching the surface here. With
okay, so Johnson, last question. You know, our favorite question that we always ask. You know, for anybody that's new here, in your opinion, top 3 reasons why investors should consider Peak today.
Okay, I'm going to repeat the same thing. It takes great people to make great companies. It starts with the team that we've been able to assemble. More and more, like, I mean, we have more quality people joining our team. We added a director, a very experienced director earlier this year. We added a special advisor who's been very, I speak to him on a regular basis. a lot of great advice, and he shares my vision, and he's helping us basically execute our business plan. So the number one thing is the team that we have in place. The second thing is just the potential. I mean, the sheer potential. Yes, the fintech market, but you just touched on the analytics, the data. That's something that we haven't even scratched the surface yet. So the company's got huge potential. We've already proven that there is demand for our services. You look at the company's growth, revenue growth over the last couple of years, and that growth is expected to continue. So second thing is the market potential. Third, last but not least, is I'm sorry, but this company is grossly undervalued. I don't know what we're trading at today or whatever. We have made some progress, but there is still a lot of room here for growth in this company. So if you're looking for an undervalued fintech company that has a huge amount of potential, then I would say that you should consider Peak Fintech.
Okay, Johnson, on that note, I want to thank you, and we look forward to having you on the next live stream, and then hopefully we'll have some time to go through all the questions, because we're definitely by next week you're probably going to have we're going to need like at least an hour and a half to go through everything. So Johnson, thank you again.
All right, thanks, Jack.
Oh, we got cut off. Okay. Okay. So thank you everybody for joining us today for Peak Fintech, and let's get ready to meet our next presenter on the live stream. Let's see, is Brandon? Are you there, Brandon?
Hey Jack, how are you?
Okay, fantastic. All right, let's get everything set up here for Icanic Brands. Okay, we got the, let me just pull this up over here. Okay, everything is good. All right. Okay, so Brandon, thanks for hanging by. Okay, welcome everybody to Wall Street Reporter's Discovery Day live stream. Today we have with us once again, actually this is the first formal presentation from Icanic Brands, CEO Brandon Koo. The company's got some really exciting things happening in the cannabis space. The cannabis space is coming back. So we're gonna, Brandon is gonna give us a full presentation. We'll open up for Q&A. Again, and if we have anybody that's new in the audience, if this is the first time you're joining us, our goal with these programs is to bring you stocks which have that 10x to 100x upside potential. We've had 3 of those 10 baggers, 20 baggers in the past 6 to 9 months, and we're going to find out if Icanic is going to be number 4. We're looking for the 4th one. We'd like to close out. We'd like to close out 2020 with 4 10 baggers. It might take maybe by February, but we'll see. So again, the goal is, look, we're presenting companies that are going after 3 things. Big multi-billion-dollar market opportunities. These companies are at key inflection points at the threshold of explosive growth, and they have multiple catalysts in place that could ignite that growth. And I think if you watch this presentation with Brandon, you're going to see that, Icanic kind of, fits the bill with all 3 things. But you check out the presentation, ask your questions, and then decide for yourself if Icanic Brands is going to be our next 10 bagger. So Brandon, let's you take it away.
Sounds great. Yeah, so thank you for having me, Jack. It's always good to connect. For everyone that I have not met, pleasure to meet everyone. So I am the CEO of Icanic Brands, and I'll kind of give you a walkthrough of obviously why we're excited, why we think this is a huge opportunity, and kind of where we're heading in the future. So who are we? So Icanic Brands is a leading California cannabis company. We are focused on the largest markets in the most competitive space. We think that's, a lot like Napa Valley wine. We think that no matter where you can grow wine, people are always going to realize and know kind of Napa Valley is kind of a leader. And so we think the same thing applies to California cannabis. So our goal is to kind of own and grow in the most competitive, largest markets. We are building a California-based vertically integrated business, everything from cultivation onto labeling and manufacturing, with the goal of a run rate of around $30 million. But the focus for us is that we focus on not only a very profitable, large top-line business, but really a business that is built on foundation with a gross margin profile of over 50% in all of our leading SKUs. So, as everyone has probably seen, a lot of excitement last night with the election. Obviously, in a highly regulated space, the election and things like that have a huge impact on our business. I think we're gaining a lot of momentum towards federal legalization. Even just last night alone, 4 states passed adult use. Another state passed medical. We think that, taxes and job creation and social justice are going to be huge components for the cannabis industry, right? They're kind of huge headwinds for us to kind of really grow into this idea of federal legalization and being able to kind of deliver our products to consumers, not only in California, but eventually, across the US. So we're very excited about that. The total addressable market is huge, right? Cannabis sales in the US alone this year are expected to reach almost $16 billion, 16 billion with the B. That's a huge total addressable market. Obviously that's, from 2019 alone of 12.1 billion, you can just see, that's almost 30% year-over-year growth. And certainly when you're talking about these types of numbers, it really kind of becomes staggering. The other components, obviously I mentioned that, we are focused on California. Some recent BDS stats came out recently around the performance in September. Just to give you an idea, California alone did $141 million in just the month in flower sales, and almost $36 million alone in September for pre-rolls. So, I think all this goes to show is that there is a huge market opportunity in cannabis across the US, but I think even a bigger one where we are based, focused, and really do our business, which is California. Some more stats here on obviously the market size. Again, it is a huge market, total addressable market. It's growing. There's been a huge shift into the adoption of cannabis, and we think that's only going to continue to grow, potentially with this new government. But yeah, we think it's a huge opportunity and one that we're very excited to be in. So again, why Icanic? Right? A lot of people have probably invested in cannabis. Some have done well, some have done bad, but really, why invest in us? We take a little different approach than most companies. We as a team have really kind of built our business and our team around combining excellence in traditional business from other industries, but also maintaining and combining that with legacy cannabis expertise, right? And so we think that those two areas combined are something which really gives us a competitive advantage. Obviously, our focus, is building a strong brand portfolio, giving us the ability to acquire and tuck in and create our own brands, doing it in a way that is obviously profitable, focusing on our gross margin profile, again, with the goal of all of our SKUs having above a 50% gross margin, which is really the foundation of our house. Obviously, as I mentioned before, we are California focused. A lot of other companies out there, try to canvas the US, try to be something to everyone. Our focus is, again, if we can win in the most competitive market, quite frankly, in the world, we know that that'll translate well as we kind of expand into kind of future geographic regions. And then a little bit of what I'll touch on in the future slides here, but we are focused not only on IP, but doing it from a technology perspective, right? And leveraging technology, which unfortunately, cannabis has kind of been a slower adopter. Technology really hasn't been incorporated as much, and so we are really trying to bring a technology-focused approach that will ultimately improve and give us a kind of superior gross margin profile. So again, where are we at today? In California, we have a 13,000 square foot cultivation facility in Sacramento. We have a 2,700 square foot manufacturing facility located in Oakland. We are actually moving to an almost 7,000 square foot manufacturing facility in Northern California. Obviously, for us, it gives us a tremendous increase in manufacturing capability. We are kind of in a lucky situation where we are having a hard time keeping up with the demand. We literally cannot make enough pre-rolls to satisfy the demand. And so to kind of solve that, we're moving to a larger facility that's almost 3 times the size, again, in Northern California. I would also note that this city also has a 0% city tax for cannabis. So it's a very strategic move for us. We are also in the process, and I'll touch on this a little bit later, but we are bringing in our second state-of-the-art pre-roll machine, which again, as we kind of get back to production, this should significantly increase our overall production and kind of help us satisfy that demand that we're seeing in the marketplace. We are also in Nevada. We did a tuck-in acquisition last year, able to begin to lay the groundwork in Nevada. We have a 4,000 square foot cultivation facility. We have a 10,000. We have the ability to expand an additional 10,000 square feet of cultivation. We have a 3,000 square foot manufacturing facility. All of that is housed on a 1.5 acre property that Icanic Brands owns outright. Nevada will be kind of the next stepping stone for our brand. And so for us, it was important for us to kind of lay the groundwork and begin to kind of build the pieces and put them in place so that when it was really time to kind of, bring our brands to Nevada, we were well positioned to do so. Our leading brand today is a company called Ganja Gold, one of the leaders in the infused pre-roll space, and also one of the leaders kind of just in general when it comes to the overall pre-roll market. It's a premium brand. It's been around for 7-8 years. We're in 375 stores with this brand. And so it's really a category leader for us, gives us a tremendous competitive advantage, both not only for the company today, but then also to use it as a cross-selling promotion and ability for our sales team to kind of sell, not only future brands that we create, but also tuck-in acquisitions that we make in the future. Little bit of stat here, currently this was a bit of a snapshot, but currently ranked 5th in the overall pre-roll market. Again, the pre-roll market encompasses, the pre-roll space as a whole. We are to date mainly focused on the infused pre-roll space, of which we are one of the subcategory leaders. Another brand of ours that we created was a company called Taylor's. While Ganja Gold is focused on the premium market, both in potency and in price, we saw a hole in the market at the lower end of the market, right? And so because we have all the pieces in place, and I'll kind of touch on them here in the next couple of slides, but because we had the pieces in place, because we had the data-backed knowledge from the customers, and because we had this growing demand from our retail partners to satisfy this lower end of the market, we came out with a product that is really a 1 gram non-infused pre-roll under the Taylor's umbrella. It wholesales for about $2.75. And again, satisfying the market where there is the most velocity and kind of an additional asset for us as we kind of look at, basically at the end of the day, being able to provide solutions to every demographic and every type of consumer, in the California space. So again, as I mentioned, there's a lot of cannabis companies out there, right? And for us, it was really important to kind of take some of the lessons that we've learned from traditional business. As I mentioned, our team is made up of folks from the traditional business world, taking real world principles, real world focuses, but also combining that with the legacy expertise of the California market, which is huge for us, right? And so our focus has always been, if we can build a great foundation, we can accomplish a lot going forward. And what does that great foundation get us? It really gets us a superior gross margin profile with our goal of 50% plus gross margins on all of our SKUs, right? So we knew that if we could build a foundation focused on these three pillars, it would set us up both to run a profitable business in the near term, but also set us up, position us very well for explosive growth kind of in the future. So those three pillars for us are our technology, our sales platform, and our vertical integration. All three are crucial to kind of our overall story and how we achieve our superior gross margin profile. And so for us, really this year has been about establishing that foundation, establishing the three pillars, and kind of using this as a lens for everything that we kind of do going forward. So technology. So as I mentioned, a lot of cannabis companies have not really incorporated technology like we have into their overall business plan, right? A lot of other industries are trying to automate and leverage technology to increase margins, reduce the need for human labor. And so for us, with our kind of traditional business experience, we've really taken that approach to our company and trying to kind of bring it into the cannabis space as a whole. So what do? Our whole goal with technology is to increase margins and decrease the need for manual human labor. I'd be lying if I said that we saw COVID coming in 2020 and that your manual minimum wage workforce would be a tougher thing to manage with social distancing and all those components. But luckily we had the foresight to know that if we could reduce our need for human labor, it would allow us to scale efficiently, and doing so in a way that increased our margins. So about 2 years ago, we developed a one-of-a-kind pre-roll machine with some leading engineers out of Silicon Valley. These guys were used to building equipment, one-of-a-kind equipment for Tesla and other Fortune 500 types. We were able to get them to kind of co-develop this technology with us. And so, I'm sure people have seen other types of technologies out there. For us, the real, and we've looked at all of them. To be honest, we've looked at all of them and trying to incorporate them potentially into our overall manufacturing process, but we just didn't find anything that really kind of did it A to Z, right? It's one thing to leverage a piece of technology that, ultimately grinds pre-rolls into dust. But at the end of the day, if that's not what the consumer wants, you really don't have a solution, right? And so I think, our one-of-a-kind technology has really kind of proven success for us. If you look at kind of the landscape, there aren't other companies that have leading brands in the marketplace in California who are leveraging technology and an automated pre-roll machine, like we have. So again, technology has been a huge component. Leading the way is obviously this one-of-a-kind pre-roll machine that automates the pre-roll process that we co-developed with some of our leading engineers based out of Silicon Valley. The second pillar of our business is our sales platform. Again, we're in over 375 locations in California. We have a sales team of 7 people, 5 out in the field, 2 doing inside sales, 1 focusing on the social media sales and leveraging our marketing platforms, and the other kind of manages our sales process, working with our distributors. So we have a very robust senior team. I would argue I would put them up against anyone else in the space in California. But the beauty of our sales team is we built it not necessarily for where we're at today, but we built it for the future, right? So they are in all of these locations. They're calling on these accounts every day. But it also gives us the ability to cross-sell and to kind of give them additional SKUs, additional brands to sell in the future, right? So give you an example, when we launched our Taylor's brand, it was really easy for us to gain large-scale penetration because we had the sales team in place, and we could simply add on an additional brand that they could then sell as they were kind of working with their retail partners on a daily, weekly, monthly basis. This also sets us up well for this next layer of growth as we look at tuck-in acquisitions, additional brands that we're creating. Maybe we launch a brand that's focused on seniors or other segments of the market. I now have the sales team, the sales platform to quickly get that product and that brand penetrated, throughout California. I think it's an interesting component because if you look at a lot of the BDS analytic reports, it's not always the companies that have millions and millions of dollars to spend on marketing. They're not getting their shelves on product, right? And as evidence, they're not the leaders in the various categories in California. California is a very different market. It's been around for a long time. It's the most competitive. And so you really have to have a sales team that is your own, that is already in these accounts where you can give them additional brands, additional SKUs, to really leverage their relationships within the retail community. Again, cannabis is not like traditional groceries or kind of even big box retail where, if you get one Target or you get one client like a Target, you're in thousands of locations, right? In California, cannabis retailers are mainly ones and twos. So there is no, it really is kind of a blood, sweat, and tears exercise getting into all of these accounts. There's not simply hey, I'm in these 5 accounts and it gives me widespread distribution. It really is kind of the ones and twos. So here kind of talks about, some of the accounts that we're in: MedMen, Harborside, Wonderland, Bloom, some of the leaders in the space. Couple stats that really pop out. Obviously, by 2020, the California cannabis market is projected to jump to $7.7 billion, right? And so for us, getting back to our focus, it's not like the total addressable market for us in California is $50 or $60 million, where in order for us to really kind of grow exponentially, we would need to move into as many kind of geographic regions as possible. With a $7.7 billion total addressable market, it gives us the opportunity to focus on the most competitive space where we have the most resources, we have the most strategic advantages, and really kind of own that market while still being able to drive significant growth. The last pillar that is obviously really important to us is our vertical integration, right? And so, without vertical integration, it really kind of exposes your gross margin profile. And, we'll give you a real world example of something that's happening, today. But, for us, when we kind of really looked at this exercise, we were paying probably $1,900 a pound for premium indoor flower, which is the main input for our pre-rolls. We were able to cut down through vertically integrated, having our own cultivation. We were able to cut down, that cost per pound to between $1,000 and $1,100. The cost of flower in the overall makeup of the pre-roll cost of goods profile is the single largest cost of goods input, meaning that if we could decrease the single largest cost of good input by almost 50%, it would increase our overall gross margin profile significantly. As I mentioned, we're kind of in a unique environment right now. Obviously, we initially decided to kind of vertically integrate to kind of increase our margins. But what's happened since in the California market is you've had an indoor flower shortage, right? So now prices per pound for indoor are $2,500, $2,600, $2,700 a pound for those companies that did not vertically integrate. While the price of their raw input is increasing now by 50%, the prices at retail and shelves have not increased by 50% for finished goods, right? So they're literally eating that loss in their gross margin profile. For us, again, because we were able to vertically integrate at a very early stage, it allowed us to protect our margins. But in a situation like this, we're able to actually sell our excess capacity when it comes to our raw flower and actually take advantage of that market, right? Still knowing that we can kind of produce a pound of indoor for $1,000 to $1,100, and now being able to sell at that kind of current market, it's a very good position to be in, and one that we're certainly very very proud of. So again, where does the market head? Where do we head as a company? For us, again, we are focused on the California market. We think it's the most competitive space with the most discerning customers. And again, $7.7 billion by 2022 gives us a very large market to tackle. So we'll continue to drive growth in California. Our sales team is continuing to open up new accounts on a daily basis. As we kind of find ourselves in this very unique situation, a lot of cities that we're finding in California who may have not been open to having cannabis maybe 6, 7 a year ago, now with everything that's gone on from a COVID situation and their inability to increase their tax base, they're looking at cannabis as an easy way to increase their overall city taxes. So we're finding that a lot of cities are pushing rapidly to include cannabis in their overall cities, which increases the number of doors, number of retail shelves for our sales team to go after. So we'll continue to kind of focus on that legacy brand opportunity, both selling our category leader in the infused pre-roll space, which is Ganja Gold, but also kind of cross-selling with the additional brands that we create. Again, launching Taylor's further into the marketplace will be a huge opportunity for us. The other part of this California revenue growth story that I haven't touched on is, again, we have the 3 pillars in place, right? We have the vertical integration, we have the sales platform, and we also have the technology and manufacturing process to be leaders in the overall pre-roll space. And so we've been approached by a lot of larger players in the space looking for us to white label and contract manufacture their pre-rolls, coming from different business or other industries. Typically people think of the white label space as very low margin, unsexy. But for us, I know that because we have this 3 pillar system, I can build a white label business that is complementary to our existing business and do it in a way that is still kind of targeting that 40% gross margin. So, not only are we able to kind of grow significantly our top and bottom line through the addition of our white label business that leverages the capacity that we already have, but it also kind of acts as a Trojan horse, working with some of the largest players who want to enter the California space, right? So I know that if I can become integral to their overall supply chain for a leader, a larger company, I become crucial, and it serves as a bit of a Trojan horse for a strategic relationship down the road. So it's both top and line driven, but then also some of the intangibles like developing some of those larger relationships and becoming integral to the overall supply chain for some of these larger players is our focus. So California kind of continuing to grow revenue is a big opportunity for us. The second is our brand acquisition strategy in California, right? So again, all gets back to leveraging our 3 pillars. I know that I already have those pieces in place. It allows me to go out and look at acquisitions, looking for brands, distressed brands that are doing $200,000 to $500,000 a month in sales. A lot of times these brands get themselves in trouble, not necessarily in kind of some of these legacy brands, not necessarily because they don't have shelf space or they don't have top line, right? There's a handful, there's plenty of those out there. The reason that they don't kind of excel is because they don't have the gross margin focus, right? So they may have a 25% gross margin profile, literally losing money on every single unit they sell, but they are on shelves. They are doing $200,000 to $500,000 in top line business, but real no prospects for kind of not growth in the future, but also doing growth profitably, right? So I know that I can come in, acquire these brands using kind of royalty models or all stock deals. And to be honest, I don't care what their existing gross margin profile is. I don't care if they're losing money hand over fist. For us, the main focus is acquiring that shelf space, acquiring that brand IP, knowing that I can switch out their supply chain because I already have my existing supply chain in place. I already have tremendous economies of scale, vertical integration capabilities with our flour already in place. So I can redo their cost of goods overnight and make their gross margins literally from day one more on par with our focus, which is at 50%. I can wipe out their SG&A because I don't need the additional sales team, which I have. I don't need all the other SG&A, which I already have for our existing business. So for us, those types of acquisitions become very accretive. I don't have to compete with larger players looking to pay higher multiples. The other component is I know that once I acquire a brand, say it's doing $300,000 a month in top line, say it's penetrating 50 stores in Northern California, remember, I have a sales team across the state, right? I can give this brand, these SKUs to our sales team and get penetration overnight across the entire state. So I can quickly take them from 50 to giving them exposure to 375 accounts, right? So the growth opportunities are huge, but I think our focus and our ability to redo their cost of goods, bring their gross margin profile up to almost 50%, while decreasing their kind of SG&A basically overnight, because I don't need any of that additional cost, makes these types of acquisitions very interesting. And we have a great pipeline, and we're very excited for kind of 2021 and kind of what that'll bring for us. The last component is just selectively looking at growth outside of California, right? The goal again for us is to be a leader in the California space. But as we kind of continue to do that, we're able to kind of leverage that positioning in the overall market for growth outside of the state. Again, the first component will be Nevada. We've already laid the groundwork. We've already laid the vertical integration component. We'll be bringing our technology out to the state, and obviously we have the ability, with our manufacturing capabilities and our sales team already in place to kind of grow significantly in Nevada when the time is right. But obviously, wanting to do so in a financially responsible manner with kind of this gross margin profile, always at the focus. So for us, we'll move to Nevada, in 2021, bringing our suite of brands and our expertise and our kind of 3-pillar system. And we think it'll provide a tremendous growth opportunity. And then obviously looking at kind of growth down the road as opportunities present themselves. So some kind of basic, shareholder information. I think the important component to note here is that, again, 70 million shares are locked up until end of 2021. These are kind of leading shareholders for us, and also leading shareholders as part of the acquisition that we made with Ganja Gold. Again, the Q2 performance, which is our latest published financial results for the quarter ending April 31st. Again, we did just over 1.7 in top line for the quarter. Gross profit of $770,000, which is a gross margin of 44.8%, and we were able to make a nice little net income of just over $4,000. To give you guys some perspective, the quarter previously, I think we did about 16.6% gross margin, and we had almost $1 million loss. So the train for us is moving in the right direction. Again, 2020 was a year where we were building our foundation, getting our margin profile in place, really kind of building for scale. And we think that 2021 is the year that we're able to kind of capitalize on all of our hard work, really kind of grow this business and continue to be, a leader in the California space. So yeah, with that, I hope that, it gives everyone kind of a better picture understanding of where we're headed, and kind of what we're focused on. And again, we're very excited with kind of the headwinds that we're seeing in the California cannabis space, but also in the market as a whole.
Okay, Brandon, let's jump into some questions. Here we go. We have Graham is asking about, can you speak to the importance of being able to pre-roll a product that is consistent each and every time?
Yeah. So, in California, the pre-roll market only makes up about 9% of the overall market, right? And so I liken it to cigarettes, right? How many people are rolling their own cigarettes at this day and age, right? Sure, when cigarettes first started, everyone was hand rolling. And the reason they were doing that is because they needed the consistency and the quality that they thought only they could deliver. But it was timely, it was costly, it was, to be honest, a real pain. And we're seeing the same thing in the pre-roll space. Because historically a lot of these pre-rolls have been done by hand, you have human labor, it's tougher to scale, it's tougher to provide quality, consistency. all those things that everyone looks for in a traditional consumer product. And so for us, the technology reliance has been huge for us because we know that we can deliver the same product every single time, right? As consumers, we all want consistency. And I think that for us, the reason that we're so excited about the pre-roll space is knowing that we think that in the future, the pre-roll subcategory can be the leader in the industry, right? As I said, in September, in California alone, flower sales were $141 million and pre-rolls were only 36 million, right? There's no reason that can't flip in the future. But again, it all starts with consistency, giving the consumer the same product time and time again. And for us, we realize that, you can only do so much with a large labor force. At the end of the day, you need to leverage technology to kind of create that consistency time and time again.
Yeah, so so it's interesting. I think Brandon, this is like your second time on our program. The first time we had like a kind of a chat interview, so to speak, and I've noticed that there's sort of, you consistently talk about the margins, the high, the healthy margin profile. So the company is focused on profitability, basically. That's the bottom line.
Yes. Yeah. For us, again, we see a lot of our competitors race to try to get product on the shelves, right? But if you're losing money every time you sell a product, to be honest, you have no reason of being in business, right? So for us, the focus of 2020 was really to ensure that we built this 3-pillar system that's crucial to our business, allowing us to kind of achieve that 50% plus gross margin profile for all of our SKUs. And we knew that if we accomplished that, we could kind of scale rapidly, with additional brands and additional tuck-ins, but be really well positioned for the future.
So the pre-roll is kind of that's kind of the company's main, that's kind of the secret recipe. That's the main focus, is the pre-roll.
Yeah, again, our focus is we wanted to be laser focused, right? I think in any business you look at where are your strategic advantages, right? And where are your competitive advantages? And for us, they all really point to the pre-roll space and what we call light derivatives. So anything within the supply chain of pre-rolls. So again, our focus is based on pre-rolls because that's where it gives us our competitive advantage, right? We have the technology, we have the vertical integration, we have the sales team, we have these pillars that allow us to really, hit above our weight class. And so that's our focus, everything pre-rolls and then light derivatives of the supply chain pre-rolls. Okay,
so we got a comment from Lisa saying that once they try the pre-roll, they're going to stick with it. I mean, it's going to be like ordering food.
Yeah.
Comments.
That comment was spot on, right? People are lazy, but I think the reason that the pre-roll space is not taken off like others is because when you get a pre-roll, right, you don't really know what's inside. And so a lot of companies have put trash inside because they know it's wrapped and they know the consumer won't be able to see what's inside until it's, too late, right? Until it's at home, right? So, for us, I think why we've been able to get in 375 plus locations is because we've built a reputation for quality. Consumers know that they are getting quality indoor flower in their pre-rolls, something that not many companies do, and not many companies do it consistently. And so, again, it's really earning that consumer's trust that, hey, even though you can't see what's inside, that the quality of what's inside is going to be top notch. And then, to the viewer's point, it really is, people are lazy, right? Again, it's why do people buy cigarettes? Why don't people roll them? It's time consuming. Everyone's busy. It just is not really effective.
Yeah, it's interesting. I mean, it's kind of like, everything you're saying, it kind of speaks to the development of brands, product brands, 150 years ago, it was delivering, before kind of the 20th century, it was that brand represented a quality product, and people, it was consistency. And, that's incredible. So here we go. Oh, so we got Graham. We got a couple of questions from Graham coming in. He's asking, with all the new states legalizing cannabis, where do you see the most potential? Do you see more opportunity with the white label side of the business?
Yeah, for us, again, with a $7.7 billion total addressable market just in California, we do think that as more and more states open, you'll still continue to have most of the eyeballs on California, right? Again, I use the analogy to Napa Valley wine, right? You can grow grapes, you can make wine in pretty much any state in the US, but why do people continue to follow and want the brands that they have in Napa Valley, right? Napa Valley has been a category leader and a global leader in the space. And so for us, we have the belief that California is going to be that same for the cannabis space, right? So if we can build category leaders, brand leaders in California and doing it at a highly profitable, with a highly profitable focus based on our 3 pillars, it presents a huge opportunity to grow in California and then eventually expand as legalization happens. Touching on the white label business, again, we see that as a huge opportunity, right? So if I can go back to kind of this move that we're making to Northern California, we literally cannot sell, we can't make enough pre-rolls to meet the demand, right? And so we are moving to almost a facility that's 3 times the size. We're also hoping to take to land our second machine, which will be ready hopefully in Q4 of this year. Again, that dramatically increases our ability to produce as well. And so all that's to say is that as we rapidly increase our production capability, this will open up the door for us to really enter the pre-roll white label space in a meaningful way. Again, we have large companies, brands that really want us to manufacture their pre-rolls because, quite frankly, making pre-rolls, manufacturing pre-rolls is a tough endeavor, right? Brands don't want to do it. They'd rather pay someone handsomely to do so. And so, again, not that I want Icanic to just be a white label business, but as a complement to our portfolio of leading brands, it really makes sense for us to, make a nickel off of dimes, quarters off of every single unit that's in the marketplace, as opposed to just making money off of our own, branded IP.
Okay. So we get a question about the California market. Is it, it says it appears saturated. Can you discuss margin compression, brand recognition, loyalty, and recurring customers? Of California.
I think a lot of people, have this impression that, the market is saturated, margins will compress. I'll give you a real world example. A year ago, we were paying $1,800 a pound for indoor flower. Right now, we can sell our own indoor flower for $2,600, $2,700, $2,800 a pound. Right. So in many ways, brands and premium are winning. Right. And so just like in a lot of other industries where competition is even easier because it's not as highly regulated, for us, what you're really going to see in places like California is the winners will continue to win and a lot of the losers will go away. Right. It's really tough to run and have a profitable cannabis business, right? If you look around the industry, and a lot of them don't have the gross margin profile that we have. And so if you're losing money on every unit that you sell, eventually you're going to go out of business, right? So we know that if we can kind of keep our focus on our margins, it'll provide a lot of opportunities for us, but then also strategically, we can look at picking up some of those brands that just couldn't make it, but had a little bit of shelf space and know that we can kind of make those acquisitions be very accretive day one.
Okay. No, Brandon, everything comes down to it's like you keep this focus on the margins, the high margin profile. It's a lot of companies talk about big picture revenue, but this is so the bottom line is you're very I get the sense that you are very, very laser focused on profitability. That's the takeaway. Yeah.
It's a huge focus for us.
So Graham I'm not sure if I understand this. How long does it take to produce one of the machines? Or I'm not sure if I understand. Maybe he's asking how many pre-rolls can you make? Graham, I don't know if you want to, or do you understand the question?
Yeah, I mean, from a timing perspective, obviously this type of machinery is one of a kind, right? So all the pieces, all the components are custom. It probably takes us anywhere from 3 to 4 months to actually make a machine. Again, COVID doesn't help anyone in the industry, right? A lot of these folks, it's just a longer lead time. But yeah, we are excited to kind of land our second machine, which again should increase dramatically our overall production capabilities. Right now we're only running one manufacturing shift, right? So we're running 8-hour manufacturing shifts 5 days a week, right? And so our focus in the near term, obviously with our larger space, is not only to have a larger footprint, but it's also to run a second and third shift eventually, right? So again, 2xing and 3xing our overall production capability and capacity to kind of meet that overall consumer demand is something that we're working very hard on.
Okay, yeah, Brandon, that you answered this question. Yeah, so basically he was asking like how long does it take you to produce the machine? So yeah, that is pretty interesting here. So Lisa's asking about any acquisitions in the pipeline.
Yeah, we have a handful. We're very excited about. Again, this is going to sound down, but with a lot of companies really struggling, right? Unless you're able to kind of do it at scale with a technology focus that can really give you that superior gross margin profile, a lot of these businesses are really kind of struggling, and so we're talking with a handful right now that frankly might not make it, right? But they become tremendous assets for us as a company because, again, I can redo their cost of goods profile, increase their gross margins to kind of that 50% target for us day one. And then also knowing that I don't need to bring on any of their team members, right? I have all the components. I have the sales team. I have all this already in place, which again, the ending result will be that a lot of these transactions will be extremely accretive for us.
So I think Lisa was mentioning, Brandon, you can see the questions when they pop up on the screen on your end?
Yep.
Okay, okay. So she was asking about gaining shelf space from failing brands. Are there a lot of them in California right now?
Yeah, again, for us, it's kind of like that dual focus, right? Any brand that is struggling, if we do acquire them, we want to make sure that we capture that shelf space, right? So we see it as a dual opportunity. The companies that are going out of business that just can't make it, they are falling off the shelves, and it creates more of an opportunity, more shelf space for us, right? That being said, if we can kind of catch them at the right time where they're still on shelves, but obviously struggling financially, then we can maintain that shelf space, on their existing accounts. And then remembering that I have, a 7-person sales team, I can give those products to really kind of expand the reach. So these types of things kind of have a dual focus for us, but something that presents a big opportunity.
So I think maybe we should also address the concept that I think maybe not everybody understands like the kind of the value of having that the machine, the ability to create that consistent product, because I think we talked about before that there's different strains. It's each strain has to be rolled in a different way. There's a lot of variables, and that's why you kind of have a major advantage in the market. This is kind of like a massive competitive advantage that your machine offers. Can you talk about that a little bit?
Yeah, so I'll be honest, when we first started this project, when the team first started this project 2 years ago, we thought, like a lot of people, it would be a pretty easy process, right? If you think about cigarettes, you think about canning, you think about bottling, everyone's expectation was this is going to be a really easy thing. And part of the reason why it's taken us 2 years to perfect this process is that along the way, we realized that, while cannabis looks like cannabis, when you really begin to kind of grind it down, you realize that the properties, the densities, the makeup of every strain is very different and has the ability to be very different. And then even taking the same strain grown even in an indoor environment at different times of the year can result in a very different consistency, right? And so the other factor is that in the industry, it's always about what's new, right? If we just made the same strain time and time and time and time again, there wouldn't be as much demand for our products. People are looking for the newest and latest. We're constantly coming up with new strains, mashing new strains together, taking two of our existing ones and combining them. So all that's to say is what that results in is every time we run our machine, the consistency of the input can be different, right? And so anyone who's worked in automation or machinery knows that in order to get the same consistent output, you really need to create and put in the same consistent input, right? And so the reason that a lot of other machines or companies have struggled with automation is because you really need a piece of technology that is flexible enough to handle the various types of inputs while still delivering the same output. And again, that's something that we've learned firsthand. Again, I'd be lying if I said that we had that expectation in the future, but it's certainly what has allowed us to kind of really gain an advantage amongst our competitors.
Lisa's asking about, can the machine make different sizes, weights, changing molds?
Yeah, so that's a great question. Two stats. So right now, all of our units are 1 gram pre-rolls, right? Across all of our brands, we're only making 1 gram pre-rolls. 1 gram pre-rolls only make up 29% of the overall California market, right? So we have the ability with our machine to do different sizes of pre-rolls. We'll be launching a 0.5 gram unit, which is obviously very popular these days. But again, we're only satisfying and playing to roughly 25% of the market with our 1 gram units. So as we launch additional sizes, it's going to be a huge growth opportunity for us. The other thing is that our pre-rolls are all singles, right? So we don't have multi-packs yet. We don't have 2, 3, 4, 5 packs. Single packs or single units only make up 52% of the California market, right? So again, that provides a tremendous growth opportunity, one that we haven't focused on yet, but that's certainly in our near-term pipeline to not only bring to markets, pre-rolls of different sizes other than our 1 gram, to focus on the remaining 70% of the California market, but it's also to focus on the multi-packs, which again represents half of the overall California market as well.
Brendan, any comment on this? You have any news? That was going to be my next question here, is what kind of news flow can we expect coming up?
Yeah, I think the biggest thing for us again is that pipeline of acquisitions, and then also what we're working on and what we're focusing on within our own brand. So we'll be announcing as we kind of go the new SKUs that we're bringing to market within our various brands. I would look for our focus on not only different size products, right? So looking at the 0.5 gram market, which is a huge growing part of the California market, but also this idea of multi-packs, that's going to be a big thing that, again, really opens us up to kind of significant growth. Obviously, the launch of the second machine, which should really increase capacity. We're very excited about that. And then, our acquisition model, again, we have a pretty nice pipeline of opportunities that kind of fit what's right for us, right? Again, what's right for us might not be right for everyone, but having that focus on gross margin, getting into a situation where we're acquiring brands, not companies, not all the overhead, not all the things that kind of got them into trouble. We really want the brand, the shelf space, and we know that if we can take that, we can, really kind of create these accretive transactions. So we think the next couple of quarters are going to be very busy.
Okay, I think we've covered everything. So Brandon, to recap, our favorite question here is top 3 reasons why investors should consider Icanic Brands stock today.
Yeah, so the number one reason is, we are poised for huge growth, right? Again, 2020 has been about building the foundation, but 2021 is going to be really taking advantage of that foundation that we've built, right? Again, we're only doing 1 gram pre-rolls, which represent 29% of the California market. We're only doing single packs. We're not doing multi-packs. Singles represent, 50% of the market, right? we are only doing one shift, right? We're focusing on getting a second shift and a third shift. We're also increasing our manufacturing floor to almost 3 times, bringing on additional machines. So all these things lead to the idea that, we are setting ourselves up for huge growth in the rest of 2020 and obviously 2021, but all leveraged on technology, right? Which is a huge component. The second real reason is, we own and are acquiring and developing leading brands in California. California is the most competitive market with the most discerning customers. But at the end of the day, it still has the potential to be a $7.7 billion business in 2022. So we're not talking about owning a very small pond. We're talking about being a leading player in the most competitive and largest market, really in the world, right? And then the third component is the team, right? Again, we have been able to marry legacy cannabis operators, legacy cannabis expertise, which is invaluable, when you're talking about serving, the legacy consumers, but also bringing on kind of world-class business expertise and kind of marrying the two. We have PhDs on our cultivation team that are looking and thinking about the growing habits just differently, right? A lot of it historically has just been growing cannabis, right? But there's a reason why other industries, other produce industries have really kind of leveraged PhDs, technology. And so we're doing the same when it comes to cannabis. So yeah, the first component is our team.
Ag tech, right? That's the new thing.
It's a big opportunity. And it's something that's, ag has been slow to adopt. And cannabis is even much slower, right? So we're trying to, again, bring technology, bring expertise to the forefront to really kind of give us that competitive advantage.
Excellent. Brandon, on that note, I want to thank you, and I want to thank everybody in our audience for joining us on today's live stream. And we hope to have you back the next couple of weeks once you got some exciting news out.
Sounds great. I appreciate you having me, and thanks to everyone who tuned in today.
Thank you again.